much for the calls this afternoon. And with that, let's move to our next conversation. Shibani Sircar Kurian, Senior Executive VP and Head of Equity Research at Kotak Mahindra AMC is joining in. Shibani, good to have you on the show and nice to connect after a while. So, you tell us what's the call. Good afternoon. Tell us what the call is. The market's been giving plenty of opportunities. There's no runaway rally. I mean, today is a bit of a different green day. But how have you been approaching things since the start of the year?
So the start of the year has been volatile, and we have been approaching the market slightly cautiously. Now, what we have seen this year is that overall our markets relative to emerging markets have underperformed. And this is of course coming on the back of the sharp outperformance that we saw last year. And so today, when you look at relative valuations of our markets vis-a-vis emerging markets, some of that excess has corrected, but we are still above long-term averages. In terms of absolute valuations, our markets are now inching closer to long-term averages. However, what we believe is that globally, while inflation has moderated in the recent months, it's likely that interest rates possibly stay at peak rates for a longer period of time until central banks are comfortable in terms of inflation dynamics. So with this sort of a backdrop, it is possible that markets either stay range-bound or at least volatile in the near term. And what we've also seen, and now we are in the midst of the earnings season, is that while at a headline Nifty level, earnings have been in line with estimates, there is wide variation and dispersion at the stock and sector levels. And therefore, this year will be a year when you look at stocks and sectors where you have earnings visibility. And therefore, markets will be somewhat more difficult to navigate this year than what it was in the last year, where market movement was pretty much broad-based.
Okay, and where is it, Shibani, that you have earnings visibility? One sector which has done exceedingly well has been banks. But now increasingly the opinion is the NIMs will start contracting for the banking sector. If not in Q4 of FY23, then perhaps in Q1 FY24. So that alpha which the bank was generating for the market may start coming down. Where is it that you are most bullish now?
So we continue to be more positive in terms of domestic facing sectors. So banks, the overall financial services space is one of the segments where we remain positive on. Apart from banks, segments such as industrials, manufacturing, capital goods, and automobiles. These are a few segments on the domestic side where we believe that there is still some degree of earnings visibility. So if you look at even this quarter numbers, a lot of the numbers in terms of earnings has been driven specifically by BFSI and autos as segments. Answering your question in terms of banks, yes, it's true that the kind of margin expansion that we saw in banks over the last year because of interest rates moving up and also higher credit deposit ratios, that kind of margin expansion is unlikely to be repeated going into FY24. Though there is still some headroom for margins to expand for banks possibly over the next quarter. What we also believe is for the sector, the focus is now moving from credit growth to liabilities, and incrementally banks will focus on deposit growth. And therefore, in that sort of a scenario, those with a stronger liability franchise, higher CASA, higher retail deposits, as well as a better share in terms of floating rate loans will be able to protect margins. Now, one thing that we must note about banks is that while the sector has seen significant improvement in return ratios and fundamentals, valuations on the sector at a headline level are still fairly reasonable. And we believe that in this sort of an environment, BFSI continues to be well placed because you still do have visibility of earnings growth. And remember, one lever for margins overall in terms of profitability could be OPEX, where over the last, again, couple of years, banks have been spending a lot in terms of branch expansion as well as technology. And when margins start to come off a bit, you do have that lever along with lower credit costs to manage earnings.
Shibani, afternoon, Prashant here. One clear area where perhaps there is a fair bit of price damage, right? So when you're trying to buy stocks which are out of favor, consumer durables is one such space, right? You look at Whirlpool, Voltas, Havells, there is V-Guard, even smaller ones like Orient Electric. Across the board, I mean, there's a fair bit of price damage which has happened. No one wants to buy them. But these are, again, I mean, consumer stories, generate a lot of cash, low debt. What's your sense, Shibani? Is this a place and time, rather, more importantly, to get in, slowly build a position?
Yeah, you're right. So this entire space has seen a considerable amount of underperformance. Valuations are now coming to levels where valuations do reach a point where downside risks could be protected. However, remember, for the overall consumer durable space, one trend that we noticed, especially in this earnings season, has been that there has been some amount of slowdown where discretionary consumption is concerned. And we'll have to wait and see whether this is a slowdown that gets repeated over the next few quarters, or this is just a near-term fatigue that is setting in terms of discretionary consumption spend. The other factor, which has still not gone away for the sector in terms of headwind, is that there is significant competitive intensity, and therefore pricing has been under pressure, which is now reflecting in terms of profitability and margins for the sector, which has also impacted the kind of performance that you've seen where consumer durables is concerned. So we will still wait and watch. You're right that, overall, given the correction, valuations are reaching a point where downside risks seem to be lower. However, when you approach the overall consumer space, at the margin, what we have also noticed is, if you look at the story over the last maybe year and a half since COVID was awaiting, was that discretionary consumption did better while rural consumption was lagging. Incrementally, when you look at signs that we are picking up on the ground, is that rural cash flows do seem to be improving at the margin. It's not a runaway improvement, some sort of improvement slowly and steadily picking up, which then bodes well for the FMCG and the consumer staples space. Now, this is a space where we have also started seeing margins starting to improve. Pricing has gone up, and that should reflect in margins, and also lower raw material costs impacting positively on the margin front. And valuations vis-a-vis long-term averages are also fairly reasonable. So at this point in time, incrementally, consumer staples seems to be an interesting space to look at, given that we are now seeing incremental signs of rural recovery, slow and steady recovery on the rural demand side.
Shibani, we'll leave it at that. Thank you very much for joining in. There may be a rural recovery for consumer staples, but we were having a chat with the management of V-Mart, where he indicated that in the lower income group, there is still a lot